He didn't drive a Mercedes. He didn't own a Rolex. And yet, he beat the flashy wolves of the stock market, wearing nothing but white clothes and silence. His name? Radhakishan Damani. And believe it or not, this bald guy, who looks like your next-door uncle, took down Harshad Mehta, the original superstar of the Indian stock market. In this video, we are going to look into the investment strategy of Radhakishan Damani, the maverick investor who founded dmart in the year 2002 and mentored Rakesh Jhunjhunwala, the greatest investor India has ever seen.
Who do you count among your mentors in the market?
Mentor is only one, Mr. Radhakishan Damani.
Born in a simple Marwari family in Mumbai in the 1950s, Damani's father worked as a stockbroker, but young Damani didn't find the chaos of the market too fascinating. He pursued commerce at the University of Mumbai and then dropped out and started a small ball-bearing business. Yes, ball bearings, those little things that spin inside machines. At the age of 32, Damani finally entered the stock market after his father's death. While other traders chased hot tips and borrowed to invest, Damani studied business models. He started as a value investor, but soon he realized this market wasn't just driven by value, it was driven by manipulation. Enter Harshad Mehta, the big bull of Dalal Street. If Dalal Street was a Bollywood movie in the early 1990s, Harshad Mehta was the flamboyant villain, driving Lexus cars, smoking cigars, and manipulating bank receipts to push stock prices sky high. He was the big bull, and Damani, he was the white-shirted shadow. Both Damani and Harshad Mehta were on opposite sides of the same stocks and rivaled each other. Retail investors followed their every move with keen interest. While Harshad Mehta was manipulating stocks like ACC from 200 rupees to 9,000 rupees, Damani was quietly shorting them, betting they would crash. At one point of time, Damani had borrowed a large amount of money from lenders and shorted stocks with that money, betting against Harshad Mehta's stocks. But his share portfolio was in huge losses, and he was in great danger of becoming bankrupt at that time if the position kept going against him. Then came 1992. The Harshad Mehta scam, which was the biggest securities market scam, broke out in that year. Stocks crashed, people panicked, and in that silence, Damani emerged richer, wiser, and victorious. And that's when Damani made his move. He bought high-quality companies like VST Industries, Gillette, HDFC Bank, not because they were cheap, but because they were undervalued and misunderstood. He didn't try to catch the bottom. He waited until fundamentals were trading at a discount, and then quietly built his positions. Damani often waited, in cash, until the time was right. That's why he could act decisively during every major crash. After Harshad Mehta scam, during the dot-com burst, after the global financial crisis, during the COVID-19 crash. When the market panicked, Damani hit the buy button on companies with long-term earnings power. Damani believes in taking concentrated bets, not diversification. When he finds a company with a highly predictable business, he's not afraid to bet big on his picks. Warren Buffett once said, "Put all your eggs in one basket, and then watch that basket very carefully." Damani knows when you find deep value, the real risk is not betting big enough. Before Radhakishan Damani invests in a stock, he studies them like he's a promoter of that company. Damani asks himself, is this a business I'd run myself? Would I put my life savings into this if I were the owner? Can this company survive a storm without me watching it every day? Damani doesn't look at stock prices first. He asks questions like, would I want to own this business for 20 years? Is this company solving a need that won't vanish next year? Damani looks for companies which can be scaled without hiring too many people. He generally avoids investing in labor-intensive industries where the need for human labor is low. Damani likes investing in companies with positive cash flows where the amount of operating cash flows given in cash flow statement exceed net profits of the company. Average investor looks at profit, but Damani pays particular attention to the working capital cycle of a company and how fast the profit turns into cash. For Damani, growth in accounting profits without a corresponding increase in cash flows is like a six-pack drawn with a marker. Impressive, but it's all an eyewash. Damani has a unique checklist to evaluate the working capital cycle of a company. Inventory turnover should be greater than 5 times. The inventory turnover rate is essentially how fast a company sells its stock. Think of it this way: the longer a product sits on the shelf, the more it costs the company to hold on to it. That's why businesses that can quickly turn their inventory into sales often stand out as top performers in their industry. They keep their holding costs low and keep things moving smoothly. The receivable days shows how fast a company is able to recover its debts from debtors. For Damani, this ratio should be less than 30 days. Working capital is defined as the difference between a company's current assets and current liabilities. Essentially, working capital is crucial for assessing a company's short-term financial health, as it shows whether the company has enough cash to meet its immediate obligations. Working capital of the company should be negative. A company with negative working capital generally has higher cash flows, which makes the company highly profitable.
वर्किंग कैपिटल नेगेटिव B2C में ही पॉसिबल होता है, बिकॉज उसी में प्राइसिंग पावर होती है. जब आपको प्राइसिंग पावर होगी तभी आप वर्किंग कैपिटल नेगेटिव कर पाएंगे, बिकॉज आप आदमी को बोलेंगे जल्दी पैसे दो, और जो आपको सप्लाई कर रहा है उसको आप बोलेंगे मैं बाद में पैसे दूंगा. तो जब आप उधार में खरीदते हो, कैश में बेचते हो, मतलब आपके धंधे में दम है. मतलब कि B2C बिजनेस टू कंज्यूमर जो होगा, उसी बिजनेस में आपको नेगेटिव वर्किंग कैपिटल होता है. और नेगेटिव वर्किंग कैपिटल से फ़ायदा ये होता है कि आपकी रिटर्न ऑन इक्विटी बहुत बढ़ जाती है कंपनी की.